During a crisis, do you feel like you're adequately marshaling your strength as an investor? If not, stick around. We'll teach you how. On April 3rd, 1948, President Harry S. Truman signed the Economic Recovery Act, better known as the Marshall Plan, into law. Following World War II, Europe's economies were left in ruins. A devastated infrastructure, widespread poverty, and rampant inflation painted a fairly bleak picture of the continent's future. The Marshall Plan marked the United States' ambitious effort to rebuild war-torn Western Europe, stabilizing economies and curbing the spread of communism as Cold War tensions grew. The $13 billion assistance package, roughly $173 billion in today's dollars, helped Western Europe recover, reigniting trade and eventually building the modern economies that we recognize today. The plan rebuilt critical infrastructure like bridges, roads, factories, and provided economic and industrial aid to Europe's productivity systems. Beyond the physical revival, it also laid the foundation for modern economic cooperation. Sort of. The Marshall Plan fostered long-lasting alliances by encouraging countries to pool resources and adopt policies promoting free enterprise and trade. And it paved the way for institutions like NATO and the European Union. This ambitious policy saved Europe from collapse and safeguarded U.S. economic interests for a generation, as a recovering Europe became a vital trading partner and key contributor to the post-war global economy. Here are 3 lessons for the modern investor, courtesy of the Marshall Plan. First, long-term vision, even amid crisis. The Marshall Plan exemplified how strategic investments during turbulent times can yield long-term dividends for both investors and broader systems. While the immediate post-war period was uncertain and certainly risky, U.S. leaders focused on a future where political and economic stability in Europe would translate to stronger global markets and reinforced alliances. Retirees or long-term investors can take a similar approach these days. Volatile market periods like right now can obviously feel chaotic, but maintaining focus on a well-diversified portfolio and sticking to long-term strategies often works better than reacting emotionally to short-term noise. Behavioral finance teaches us that loss aversion, the tendency to fear losses more than valuing equivalent gains, often clouds your judgment during these types of crises. So focusing on growth over the long haul, like the architects of the Marshall Plan, remains key. Next up, collaboration yields compound benefits. A key feature of the Marshall Plan was its emphasis on collaboration rather than one-way assistance. European countries receiving aid agreed to work with each other economically, laying the groundwork for what eventually became the European Union. This reinforces the lesson that pooling resources and partnerships often creates a stronger outcome than going it alone. For my investors, this applies in both macro and micro settings. On the macro level, multinational or cooperative initiatives like economic blocs can drive global growth, so we need to be aware of them. And on the micro level, investors benefit by pooling risk through index funds and diversifying their accounts. Just as Europe thrived through collective action, portfolios diversified across regions, industries, and asset classes are typically more resilient against downturns. Third, prepare for changing paradigms. The success of the Marshall Plan reflected foresight into shifting global dynamics. U.S. leaders understood that Europe's economic recovery would change from an agrarian wartime economy to modern trade, technology, and infrastructure industries. Similarly, today's investors must recognize when economic paradigms shift and prepare to position themselves accordingly. Think of the transitions we see today, from fossil fuels to renewables, traditional finance to fintech, manufacturing to AI and automation. Being mindful of these shifts and strategically allocating investments to sectors poised for long-term growth can obviously help future-proof your portfolios. Behavioral economists often refer to status quo bias, where individuals hesitate to adjust strategies despite evidence of changing environments. The Marshall Plan reminds us that progress comes from anticipating change and acting accordingly. As one of the crowning achievements of 20th century economic policy, the Marshall Plan demonstrates the power of long-term thinking. Whether navigating volatile periods in the stock market, geopolitical uncertainty, or economic transitions, the principles of diversification, having a forward vision, and being adaptable are as relevant now as they were in the post-war 1940s. This episode of the History Lessons podcast is sponsored by Victory Independent Planning. Hey, are you ready to take the stress out of your retirement? At Victory Independent Planning, we put you on the right trajectory with our exclusive VIP retirement glide path. Our smart approach prepares you for what's next by optimizing your sources of savings and income, your medical and healthcare planning, your advanced estate and giving strategies, risk management and investing, and tax planning. Let us help you glide into retirement with confidence. Text Glide Path to 239-567-5477. That's Glide Path, all one word, small letter G, to 239-567-5477 and receive a link to schedule a complimentary consultation. Do it today to start your journey on the VIP retirement glide path, because your future deserves a safe landing.